Good day, and welcome to Turnaround Announcements Weekly Wraps. I'm Bob Governor, and as usual, what we'll do is we'll cover some general market stories at the start and end up with a little tech segment at the end. Our general market stories are going to be the US economy, Anglo's proposed buyout by BHP Billiton, and then the tech stories are going to be Tesla as well as Facebook. Looking at the US economy, we saw growth come in lower than expected, about 1.6% in the last period versus an expected 2.2%. That is obviously a bit disappointing. At the same time, we saw confirmation that inflation remains pretty hot. PC inflation is about 3.7%. That is a pretty high number if you think about it, that you want it to be closer to 2% for the US economy. And if you think of the combination of these two things, firstly, slower than expected growth and inflation remaining in the mid threes, that combination is pretty much the worst of all worlds. It doesn't allow the Federal Reserve to cut interest rates to try and boost the economy, and yet there is a significant indication that there is economic weakness that requires some kind of intervention. So what are we looking at the moment going forward? The number one job of the Federal Reserve, beyond all other jobs, is basically to fight inflation. The reason it puts it number one is because if you don't fight inflation as your number one job, what happens is over time people doubt your ability or your willingness to fight inflation, and therefore when we have wage increase negotiations, we have price increases over time, what happens is that the populace at large, companies at large, workers at large come to the conclusion that if inflation this year was say 4%, then you need to have a 4% plus wage increase or price increase or whatever it is next year in order to basically keep pace with what price increases are looking like. If that is the scenario that you're in, what happens is that inflation gets baked into your system. You can't escape inflation. You can't get lower because people expect inflation to be high. That kind of creates the problem of high inflation. So if you basically establish a reputation of fighting inflation no matter what, then people start believing that that's what's going to happen. So even though inflation this year might be 3.5% or 4%, you don't automatically ask for a 4% inflation related increase for the next year, because you assume that the Federal Reserve will bring it back down to about 2%. So you can say, okay, certainly above 2% or 2% it'll be effective, as an inflation related increase. And that kind of, just by doing it that, you basically lower inflation because you no longer have that automatically 4% price increase going through. You basically get closer to the target level of about 2%. And the more you believe in that target, the more you believe that the Federal Reserve has firstly the willingness and the ability to fight for that target, the more likely are you to accept a wage increase or a price increase that's close to the target. If on the other hand you don't believe the Federal Reserve can control it, you think that they don't have the ability to do that or not willing to do that, then you are not going to be as willing to accept that low increase. You want a high increase because you think that if you don't ask for the high increase, then in the next period, you're going to lose out because your wage increase or your price increase is not going to match inflation, and therefore you're going to be getting less money. That is why the Federal Reserve and any other central bank that uses this methodology fights inflation, number one. Inflation, like I said, over 3%, well over 3%, 3.5% basically. That is pretty much, if you look at what the target is, 2%, that's about 75% higher than the target. That's a huge differential. Yes, we're down significantly from the 8% we saw a little while back, 9% we saw a little while back, but still being 75%, almost double the target, it's not a great place to be. And the signs are, unfortunately, that inflation does not seem to be going away. In fact, there may be some pressures coming through that may be pushing it higher. In that scenario, what we have to concern ourselves with is that maybe the next rate move by the US Fed is not going to be a cut. Forget about worrying about whether it'll be 3 cuts this year or 2 cuts this year. It could very possibly be that the next interest rate change is an increase. That is obviously not the majority opinion at the moment, and it's not my majority opinion, but or my most likely opinion. But I do think that it is something to be concerned about and watch as we go forward. The next thing is this blockbuster, offer by BHP Billiton to buy Anglo American. They want Anglo American, but minus Anglo Platinum and Kumba Iron Ore. Okay. This is a huge deal. Anglo American is about a $700 billion company, round company. They own about 70% or so of Amplats and about Kumba, Anglo American. And so what would happen here is, let's just say BHP buys it. Then obviously they take control of Anglo's, but for the Kumba and the Amplats holdings of it, Your shareholders will probably get a payout for the Anglo American part, and then get the actual shares for Kumba and Amplats. Now, just be aware that what this would mean is that there'd be quite a massive distribution of these shares out there in the market. Remember, 70% or so is a lot of shares. So what we are looking at is a situation in which, if you are a investor in Amplats or Kumba, or looking to trade it in the near term, be very wary, because the movements are not going to be just one way. You may not even be able to say, oh, because there's a whole lot of shares being released, it's going to go short, or you can go short on this stuff. Just think of the mechanics behind the scene. Right now, there's a whole bunch of shares being held by the banks or by Anglo American at the banks. Anglo American is going to have to take those shares off from the banks and hand it to the shareholders. These banks or these like holding companies often lend these shares out for short sellers. So if you want to basically go short in Anglo American, you borrow some shares from, say, a bank like NetBank, and then you go sell it, and then later on, when the price falls down, you buy it at a cheaper price and you give it back to NetBank and you make a profit. That's the usual deal. If, however, what happens here is that NetBank says, hey, I lent you these shares and I expect them back sooner than I thought, because we have this deal that has to be closed off between Anglo American and its shareholders, well, then you have to go out and buy these shares in the marketplace. That could cause a bit of an uptick, a little short squeeze happening, because people are going to be forced to buy these shares and return it before a certain date. And as you get closer and closer to that point in time, it's going to cause the share price to go up, and people are going to be more and more nervous about the share price going up, and therefore might push it to new highs. So you could find a massive uptick in terms of the price of these stocks if such a thing does occur. Then after this does occur, then these shares are in the hands of these Anglo-American shareholders that basically got paid out both the cash and the share, of these companies that are part of Anglo's stable, plus whatever they're getting for the sale of Anglo-American to BHP Billiton in the first place. Those people may not decide to hold all these things together. Maybe when they had Anglo-American in their holdings, they maybe didn't want to hold some Amplats and beyond that. Maybe didn't want to hold Kumba, but they just thought the whole overall package was good. And it's quite likely that they may be wanting to sell some of these things after they get them in their hands. And so later on, you could find a bit of a pullback coming through there as well. So it's, like I said, a very turbulent time for, not just Anglo American, which has rocketed up quite nicely, but it could be a turbulent time for companies like Amplats and Kumba, which are going to also be affected by the mechanics of this particular deal. Now, moving on to the tech segment, we're going to talk about Tesla's results, and we're going to talk about Facebook. So Tesla's results came out pretty bad quarter in terms of earnings. Initially, the stock fell, then it rose quite significantly. Why? Well, one of the things that became quite clear from Elon Musk's talk about the results, etc., is that Tesla is definitely pursuing the cheap $25,000 car or sub $25,000 car. There were fears that he was not doing that. There was a bit of news earlier the month where we had, I think, about 10% of the workforce being fired, some key people leaving, some talks about, refocusing on robo-taxis, which is basically self-driving vehicles that drive themselves and become effective Uber cars without the Uber driver. And the market was a bit nervous about that. They would prefer to have a focus on these cheaper electrical vehicles. I don't know why, because it kind of makes no sense from my point of view. Without the robo-taxis, without the full self-driving, without the AI component, without the Optimus component, Optimus being the robot, Tesla can't be worth what it's worth right now. Yes, it's fallen down like 40% over the last little while, but it's not anywhere near the valuation of a company like, say, for instance, Ford or GM, which in terms of actual cars produced is higher than Tesla. And so if you're looking at it as a purely car company, you would say Tesla seems extremely overvalued, even at the current price. The only way you justify the current pricing is if you're thinking, yes, it's going to have full self-driving, it's going to have this robotaxi, it's going to have this Optimus robot come out, and that's going to be the thing that makes it as valuable as it is. So yeah, but the market obviously disagrees and wants to focus on the cars, and so yeah, they want more focus on the sub $25,000 car. That is what basically Tesla delivered, and the share price ran up quite strongly thereafter. Regarding Facebook, there were concerns from Facebook on a couple of fronts, most notably on spending. Mark Zuckerberg is looking to spend a lot of money on AI, and the market is very fearful about that. Remember, if you look at where Facebook was a while back here, it was a fraction of what it is right now. And the reason that it was Mark Zuckerberg was willing to spend tens of billions of dollars for multiple years, per year for multiple years, to create the metaverse. The metaverse, if you don't remember, was this kind of like online virtual reality space where Mark kind of believed that the world would live in the future. Ready Player One is like, the idea we're talking about here, to a certain extent. That failed, quite clearly failed. And the market basically was getting very angry about that, and therefore the share price was being punished. All it took to turn around this whole thing was him to say, I'm not going to spend as much money as I was spending on metaverse before, and the share price has rocketed up. Now, AI is the new thing. Zuckerberg and Facebook, which is going to be a bit more in depth right now, is looking at a different approach to AI than, say, Google, Alphabet, or OpenAI, Microsoft, okay, or Anthropic with Amazon. They are approaching, or they're using what's called the open source model. What is the open source model, and why are they doing this, etc.? So let's just begin with open source. Open source is the ability where you basically give out the technology that you create to the whole world to use in whatever way they want to use it, in the hope that they improve it, they spread the distribution, and therefore make you a dominant player in the field. The example that we often talk about is, Android. Android is a system created by, Alphabet, Google. Google created Android, but it does not control Android. It lets everybody use it. The benefit of this is that Android is by far the most widely used system in the world, phone system in the world, operating system in the world for phones. Apple makes more money, but Android is more widely used. The reason Apple makes more money is because Apple controls, iOS, and that allows it to basically control how the system works, to charge fees here, then everywhere for that system, and have higher margins. And it's a more curated, it's a safer experience probably to use the Apple system than to use the Android system. But like I said, the Android system is the dominant system in the world. Most of the developed world uses Android. Much of the developing, most of the developing world uses Android. India, China, Africa, it's Android. It's not Apple. That's the number one thing. The only place that Apple is like the number one player is like in the US, and even though it's barely the number one, and it's a big player in Europe as well, and among the very wealthy in like different parts of the world. But the majority of people use Android. And like I said, the benefit is distribution, it's innovation, etc. Now, in the current model, we have, and the same thing would have been applied to back in the day with the IBM PCs and like Apple PCs. IBM basically went out and said, this is how we make PCs. It's going to be an open source thing. Anyone can make these kind of PCs. And then you had a whole bunch of companies making IBM type PCs. Apple had a more closed system, and therefore only Apple could make that there. There, what happened was the IBM PC, which is what runs Windows and stuff like that, became, or that model of PC, kind of PC basically became the dominant PC. Apple's share in the PC market is a fraction of the total market. It's far more dominant in the mobile phone market, even though it's not the dominant player. So historically, open source has been reasonably successful. And Facebook is applying the same model here. It's creating models and it's giving it out to the public. You can go out and you can download the latest Facebook models and run them on a machine that probably costs a few tens of thousands of rands if you had to build it. And their belief is that if they do this, every smart person in the world that's developing AI programs and AI applications and so on would want to use the Facebook model called Llama versus using Anthropic's Claude or OpenAI's GPT, whatever, 4 or 5 when it comes out, because it's free. You control it. You don't have to basically pay, OpenAI or pay Anthropic for using the model, and you control it. It's not owned by somebody else. They can't change the features. They can't change things on you in a way that you would basically be disadvantaged. That seems to be a reasonable approach to things. How would they monetize it exactly? It remains to be seen. But if you've been using, any kind of Facebook product like WhatsApp and so on in the last few days, you'd see that there's now a new button there that you can use for AI on Facebook. And quite frankly, there is a significant chance that Facebook, just by having that button there, could pose some real competition to Google's search engine. It's quite possible that just by having that button there, it's going to be a real competition to, OpenAI's GPT-4. And by the way, just by looking at the latest models of Facebook, there's a couple of things I want to note. Firstly, the models are comparable by any measure to GPT-4. Okay, maybe the newest version of GPT-4 is probably like slightly better, but it's comparable. And we're talking about comparable when one guy charges you and the other guy gives it to you for free. Imagine that. Imagine one guy's basically charging you money for something, the other guy's giving you something for free, and it's reasonably similar. Who wins in that scenario? It's reasonably similar. You're going to go for the cheaper one, which is free. Okay. Second thing is that some of these models are tiny, far smaller than you would have thought given their performance. What does this mean? And this is another thing I want to point out here. If you use the analogy that AI is like a brain, okay, then the size of the model is like the size of your brain, and the data you put into the model is kind of like the education you give that brain. Facebook seems to have proven that even the models we have right now from OpenAI and other places may have a brain size of a certain size, but it's not as, and given some performance for those brain sizes, let's say a 70 billion parameter model or 100 billion parameter model, whatever it may be, that's the size of the brain, that even given those sizes, without making the models bigger, but just by training it more on better data, the performance will be improved. Just like a person that may not have like a 190 IQ, maybe have a 130 IQ, or 120 IQ, even 100 IQ, with a good education, performs better than without a good education. Okay, obviously, you're not going to become Einstein if you start with 100 IQ, no matter the education you get, but you can get significant improvements from better education. And even Einstein, at like 160, 170 IQ, whatever he was, would not have gotten there without that education. This shows the importance of data. And Facebook, by basically demonstrating this, demonstrates two things. Firstly, the importance of data, and secondly, the importance of very good data. Meaning that just crawling the internet and looking for stuff like OpenAI has been doing may not be the best way forward. Because Facebook probably has some of the best data in the world with Facebook, with Instagram, with WhatsApp, and so on. Clean data. Data that's not as, prone to, incorrect and falsehoods and so on. Obviously, you know what's happening in Facebook, etc., but compared to like in the general internet. Which means that this high quality data gives you better results even for the same size model. An interesting development there. Okay, so that's it for this week. I look forward to speaking to you guys again next week. Cheers.